Hi, everybody. It's Eric and Kirby from Divvi Wealth Management, and it's that time of year for us to do some year-end tax planning. Let's go through some of our top tips. So hi, everybody. It's Kirby and Eric with Divvi Wealth Management. We just wanted to go over a few of our top tax planning tips here before year end with you all. So I'll start. This is a checklist of 10 of our best ideas or thoughts on things you should be thinking about. Number one, review your retirement contributions and especially your company matching. A lot of folks are going through open enrollment right now, and we want to make sure that you're getting all of the dollars that you can be getting from your company as a contribution into those 401ks and other retirement plans. So let's be mindful of that and making sure you're doing everything you can there. Of course, if you can max out those plans, even better. Secondly, reviewing your traditional versus Roth 401k options within that retirement plan. A lot of your companies or the folks you're working with are now offering a Roth 401k option. We have some ways and math that we can do to analyze where we think your best bang for your buck is as it relates to those two different options to ensure that you're making the most informed choice as it relates to those contributions.
That's right, Kirby. Also, for individuals that have traditional IRA assets, you may want to consider Roth conversions, or for folks that perhaps make too much income, have too high income to qualify for Roth contributions, consider the backdoor Roth IRA. Now, there are definitely some strings attached here, so you don't want to do that without consulting your advisor first. But if it's a year where incomes might be a little bit lower, or you're in a bracket where it makes sense to pay that tax today, generally that's going to make sense if we expect incomes to rise in the future and we expect to be in higher tax brackets. It can be a good idea to take advantage of the lower rates today and convert some of those assets into Roth accounts. Also, we want to review tax loss opportunities, and don't forget about bonds. Unfortunately or unfortunately, interest rates have remained high through 2023. And so bond prices, and in many cases stock prices, have been under some pressure over the course of the year. And so now is a great time of year to review your holdings and figure out where you may have some opportunities to sell, realize some losses, and potentially offset other gains or defer those losses to help your tax bill in future years.
And tax tip number 5 is if you have an abnormally low income year, consider looking at opportunities to harvest gains. If you have some positions that you've been hesitant to sell in the past because of a large capital gain, a low income year can really be an opportunity for you to lessen that position and further diversify. This is also a good conversation as it relates to Roth conversions. So in the event that you're in a low income year, thinking about what would a Roth conversion look like from my traditional IRA into a Roth, as far as a tax consequence in a low income year, it might really make a lot of sense. The math will help us figure that out, but things we should all be thinking about. And number 6, reviewing your asset allocation. So ensuring that everything is in place as it should be, but just as importantly, your asset location. For a lot of our clients, we've been talking about asset location for a while now. It's important for us, in our opinion, to really look at maximizing your after-tax dollars that are available to you in retirement. One of the most critical ways we can do that is through thoughtful asset location, which ensures that what we do is we focus more of your growth-oriented investments inside of tax-free accounts, because our hope is that they will grow at a higher rate over time and you'll have a bigger tax benefit from that, while our lower growth characteristic investments will be held in our tax-deferred accounts as their growth rates won't be as high, and so the tax burden would be lower at retirement. So speak to us about that if we haven't already visited with you about it, and we're happy to take a look and see if it makes sense for your situation.
That's right. Who doesn't love tax-free buckets of money? Number 7, review qualified distributions or required distributions from qualified accounts. So for a lot of folks that have had IRAs or other qualified money, and you're at a certain age, you are surely aware that you have certain amounts that need to be distributed from those accounts by December 31st. This is just a friendly reminder to make sure that those dollars are removed by that December 31st deadline to avoid any penalties. If you need help calculating those amounts, of course, we do that on behalf of clients on a regular basis. So please reach out if you have any questions. Number 8, estimate your annual income. We're at the time of year now where a lot of folks probably have a pretty good idea what their income is going to look like for 2023. And if it's a little bit higher than normal or a little bit lower than normal, it may be an opportunity to perhaps either defer income into a future lower income year, or perhaps pull it forward if this year is a little bit lighter than what you might expect next year. Again, what we're trying to solve for is paying as little tax as legally required over time. And so reviewing income in relation to expected income for future years can help to that end.
And number 9, if you've ever considered funding a 529, there's a few more reasons now than there have been in the past as it relates to that. The biggest one being the Secure Act 2.0 recently passed a rule that allows for the conversion of those 529 plans eventually into Roth IRAs for those beneficiaries. So for some of the folks that have been hesitant in the past, not knowing if those dollars would be utilized, this is a great new feature that we think has some really powerful long-term impacts potentially for your kids or grandkids. So another thought there to think about here before year end in terms of gifting. And then lastly, from a charitable giving standpoint, it's a great time of year to look back through your year and decide, are there other opportunities that you want to take advantage of in terms of charitable giving? Because of some of the recent IRS rule changes, there are some advantages to lumping that giving in one single year versus spreading it out over multiple. We can certainly talk about that, but there are other strategies that we can look at as it relates to charitable giving. One of which that we have a number of folks that utilize is taking your required minimum distribution from your IRA and actually setting it up as a qualified charitable distribution to the charity of your choice. So it's just some different options there and things that we can look at. So with that, that's our 10 tax tips. Of course, as always, if you have any questions on any of this, or if there are things you just want to review as it relates to your individual financial plan, please don't hesitate to reach out. Eric, myself, Anthony, and Matthew are always here to help at Divvi, and we'll talk soon.
Thanks.